To answer your question, this is the battle we're seeing right now.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
All right, welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this week's exciting episode. And I do mean exciting, and you can imagine that we are growing very, very rapidly as a community. And thank you so much, everyone. Out there again, there's a lot to talk about during these historic times. Andrew Maguire is with us, and we are going to be going to Talking Gold very shortly. You're not going to want to miss any of this episode. Buckle up, and just before we get started, I want to encourage you, and I'm going to give you a reason to encourage you to spread the word about this channel by liking, sharing, and subscribing. Well, here it is. To date, already, Kinesis has started the Minter's yield, and that is historic, but there is a combined, as of today, $9 million. I'm talking $9 million in the various yields that are ready to be paid out. So that we're talking about the holders yield, the Minter's yield, the KVT yield, the referrer yield, and of course, the depositors yield. So for more information, you can see this. It's information available to you in the Kinesis.money back office. If you don't have an account, open up a free account, not now, but right now. And be sure to click on that bell and get this information out to as many people as you know. And also, if you click on the bell, by the way, you'll be notified in real time as these episodes go live. So with that, without further ado, let's head over to the UK with Talking Gold with the one and only Andrew Maguire. Now, Andrew, it seems that 2 weeks in this market could be it seems like almost 2 years, a long time, but I can't believe here we are again approaching the BIS mark-to-market Options Expiry event right now on Friday. And you always tell us that this event inevitably provides a pullback for the gold price. On the last episode, you suggested that last month's BIS June dip at 1765 gold would mark the bottom and provide us with the next rally point. So let's start this episode off by what are you seeing right now in the markets? Andy, over to you.
Yeah, great to be with you again, Shane. Yeah, it's amazing. Look at time fly. I mean, look, we still see the bottom as solidly in, but given we're also factoring in the unwind of literally hundreds of tons of unallocated gold swaps and leases, and we've spoken about these multiple times, this additional volatility, this unwind has generated must be factored in. So let's look at this now that we're reaching month end, and bearing in mind that Basel III accommodations kicked into play just at the beginning of this month. And here we are on Wednesday, approaching the Friday end of the month, 2 days from now, and we have another, as you say, BIS Options Expiry. So look, what we've done is we've witnessed this action since our last episode in this last 2 weeks, but what really stood out over the last month since COMEX became Basel III compliant, go figure, and that was on the 1st of July, is that the price dips have been constrained by the degree that COMEX futures contracts can be driven into backwardation. If you remember, what we discussed with backwardation is simply when the over-the-counter spot market, which is 10 times the size of the COMEX, it's a foreign exchange market. That's the where gold is traded against the dollar, the euro, etc., etc. If that price drives the futures price in the COMEX below that price, that's what we call backwardation. And this is a really important point, because now that the COMEX is compliant, it's going to limit any downside from here on. And this is going to be, as I say, severely limit the downside for gold as COMEX, because it's Basel III compliant. And the next stair-step rally point is about to be forged on Friday, 2 days from now. And when you're reading this, when you're probably getting this, it's going to be Friday. And that is the mark-to-market event that we've discussed multiple times, probably about close to $1 trillion worth of derivatives have to get mark-to-market. This is why the BIS has usually, and especially at a quarter end, but every month end, but usually at a quarter end, they will make sure that these derivatives are mark-to-market. So I think it's going to, if I had to sum up where we are, the last time we saw a setup quite like this was actually at the end of April. And really, that was when really gold was at 1767 at that time. Pretty sure it was, around about there. And then it rose $100. Well, I actually see from a wholesale market perspective, a very similar structure, so that we're looking probably roughly about $30 higher when we get to Friday. I'd be surprised because 1800 is kind of the OPEX sweet spot, the option sweet spot. So I'd be surprised if it rises above that. It'd probably get pulled back to that until Friday. It's such a huge amount of derivatives that have to get squared. So let's just say that after Friday, we would probably expect, so next week, we'd start to see a rally somewhere around about $100. And I think that's pretty much what I'm expecting from a short-term perspective. That's what our liquidity providers are also expecting. Now, as subscribers will know, a lot of additional volatility that we're experiencing right now is being generated by the closing of unallocated foreign exchange gold contracts. And as we described before, in simple terms, it involves selling the long gold leg, i.e. you have to sell the gold, buy back the dollar. Now, as this paper market liquidity begins to evaporate, as a consequence, we're evidencing intermittent air pockets as literally billions of dollars of unallocated contracts are squared. And this is a good thing. But this is the really important point to take away. It's not a free pass to hammer gold into oblivion. There is a physical side to this market. And these banks that are the market makers, that the insiders, as we call it, are constrained by the degree they can dare to put freshly physically backed COMEX into backwardation. It's deliverable. They don't want to deliver it. In fact, this has now become an incredibly careful balancing act. So actually, to underscore what we're discussing, I got an email from a Swiss refiner, Arga Heraeus, on Friday. I'm going to read you an extract from that. And let me just grab this because it'll really demonstrate exactly what we're talking about here. And this is a letter, in essence, what this letter, it kind of backs up and illustrates the evaporation of LBMA controlled paper market liquidity. And it's forcing premiums above spot, and it clearly reflects tight supply at spot generated prices. Now, this is evidence of the physical dog beginning to slowly wag the paper tail. And we're only 1 month into this 6-month window. Now, the essence of the letter notes that bullion, what it says is essentially bullion market conditions have recently changed. That's the essence of this letter. And let me just read it. And this is them. This is a Swiss refiner. The sourcing production of fine materials for nines gold and silver in particular, they say, is getting more and more complex and expensive due to current market conditions, namely overall increase of costs in logistics, low-cost swaps, volatility, liquidity constraints, and so on. Therefore, we need to adjust our quotations accordingly. And they say this information also provided to adhere to the to be compliant to the principles of transparency, fairness, as encouraged by our industry regulators. Well, I mean, this is exactly what we've been saying. There is going to have to be transparency, but that letter really is essentially what we're really saying is they then quote the wholesale prices above London spot price fixed at the fix, as they have been, as every day the price is set at the fix. Now, the price rise above spot illustrates the unwind of paper gold liquidity, and that it's forcing the spot price to simply become a reference price for physical bullion. Now, this is the first sign that Basel III NSFRs that we've been discussing are beginning to impact global physical markets. And it's identifying the discrepancy between the spot-derived London fixed price, which has always been a paper price, and what is actually physically on offer. This is not going unnoticed by central banks, competing for physical. Shane, to answer your question, this is the battle we're seeing right now. Let's not forget that the physical gold market is not just siloed to just London and the US. There are military enemies at work here, such as Russia and China, and they lead a pack of other central banks seeking to secure and repatriate gold back to back their respective currencies, right? So, I mean, even Brazil, in June they just reported, I mean, they purchased 41.8 tons in June alone, and this is just Brazil at an average price of about $1,820. Now, this is a central bank buying physical gold. There's a lot of competition. The point I'm trying to make, there is a ton of competition out there. And what Russia and China are reporting as accumulating is, in our view, nowhere near accurate, even though Russia, we know, has disclosed they're buying several hundred tons of gold. But essentially that, as we said last time, that's not from the market, probably that's going to be purchased internally, but restricts that supply coming into the market. But China, I mean, we know they are active, and we have lots of evidence they're active, and none of this is disclosed. But what this means is there are active physical buyers in the market ready to capitalize on any dislocation between the rigged spot price and the physical global markets. And that draws our attention to the exchange for physical mechanism and the need. Remember, we talked about this in March of 2020, and when it blew up. They need to avoid another March 2020 blow up, which is when the dislocation between the spot price and the physical market actually imploded. And so really, just to sum it up, Shane, I think if we had to sum it up, the physically deliverable COMEX exchange must now reflect a deliverable global price, which means any gold futures backwardations have to be carefully managed. Not like before, and this puts a constraint on the LBMA banks that would like to ditch as many unallocated contracts as quickly as possible before these unallocated liabilities land on their books at the end of the year.
Now, Andrew, talking about the LBMA and Basel III, I know that you're one of the first in the world to start talking about Basel III, and now it seems everyone's doing it. But a couple of weeks ago, there was an article basically saying that the LBMA is trying to escape the implementation of Basel III. And can you bring us up to date on why you believe that that's going to fail?
Yeah, Shane, the window to comply and ditch these unallocated liabilities before they land on the balance sheet of these LBMA banks has already contracted, really. They've got 5 months left. And let's look at where we are in this process, because it is a process. And as we discussed last time, what the original LBMA begging letter essentially said was that the clearing banks would cease to operate if concessions were not made. However, that shot them in the foot because it drew attention, unwanted attention, to the sheer scale of hundreds of tons of high counterparty risk, unbacked gold credit transactions, which is all they are, settled amongst these members daily, weighed up against this tiny fraction of physical transactions underpinning these trades. So that was it was a price that they paid for trying to make this argument. And as we summed up last time, the process of deleveraging is well underway. And look, it cannot be reversed. And that does not stop the LPMCL from operating, though. It simply means that as of January 2022, they have to operate as a physical exchange with the liabilities passed on to clients. Go figure. That's how an exchange is supposed to function. Now, getting into the weeds, though, the LPMCL clearing banks must really, they're just going to act as a clearing member from here on. But it is important to understand these guys are not market makers. And I think this is where a lot of people are looking at it thinking they're market makers. They're not. It's their clients who are market makers. Now, obviously, this has been an incestuous relationship that's been the historical problem, because obviously you've got the four banks that are still operating as the LPMCL members, but they also operate as market makers. So that's been as I say, an incestuous relationship. But there are governing regulatory factors that will ensure the deleveraging of the unallocated gold contracts will continue into the end of 2021. And look, And of course, this is nothing but bullish for the higher price of gold. And we've already seen that now with the refiners starting to pump up their physical prices based regardless of the spot gold price, which just been set again today. And what happens is it's just become a reference price. It's not the physical price as able to be delivered. So this is how it plays out from January, I think. Given the NSFRs are already influencing wholesale liquidity providers and refiner pricing, we think London will have to be compliant probably by late October, early November, not even till the end of the year. Now, if the LPMCL's clients, which are the market-making bullion banks and large traders, do not move to match these short-term deposits with long-term liabilities, meaning if they buy or sell unallocated gold by the end of the extension date into the end of the year, these transactions must be backed one-to-one by physical bullion, or they will have to roll the risk and associated haircuts onto their balance sheet. Well, compliance is not going to allow them to do that. However, if pooled or unallocated gold is matched with an equal number of ounces of physical, the transaction qualifies as Basel III compliant, and there is zero funding requirement. Of course, it won't be, even though it's unallocated and it's pooled, it'll be backed, and it will have to be. Otherwise, it rolls on the balance sheet. It's that simple. So the transaction simply flows through to the CME compliant physical exchanges where it is hedged. Now, if it's hedged, it's treated as a cash equivalent asset because it eliminates the price volatility. And this has already triggered a massive structural change in the behavior. And as unallocated open interest begins to reduce and fall and the overhead supply reduces, it will be a physical transaction that sets the global deliverable gold price. It's that simple. In other words, if physical gold is hedged, it removes the volatility risk and it qualifies to be treated as a high quality liquid asset. Now, the main point is that the COMEX is now compliant, but the over-the-counter markets are only just starting this process. They've got 5 more months to do it, but I think what we're saying is going to be a hell of a lot less than that. In fact, to buy a little time, we're aware that the key market-making banks on the COMEX have sneakily shifted their trading into London, and this means we must be a little patient, but we'll see a price rally extend into the end of the year. And obviously we know this because, I think we've discussed this, UBS, for example, in Switzerland have reduced their traders down to 2 employees. Why is that? Because if you've got a physical desk and you're not trading paper and derivatives and forwards, you really don't need any more than 2 employees to handle the physical side of the transactions. Sneakily, these guys have moved themselves. All of the market makers have moved their operations into the hidden in the smoke and mirrors world of the over-the-counter markets. But we've just given you a reason as to why they don't have free reign.
Andrew, talking about the end of the year, with all this volatility in the gold and even silver markets, are you still seeing gold heading towards 23, 25 by the end of the year?
Yeah, I think a lot of what happened in 2013 was directly related to the outlined Basel III NSFR regulations. At this point, I think it helps to just step back and look at the bigger picture. So when net stable funding ratios were finally agreed back in 2013, it triggered the commencement of central bank gold market repatriations. People have forgotten that. And that was led by the farce. If you remember the farce surrounding Germany's request to repatriate its gold stored at the New York vaults. I mean, and that was just 300 tons. But I mean, then we saw 9 countries demanding their gold back. Holland, Austria, Ecuador, Libya, Mexico, Romania. A lot of countries then demanded their gold back. Belgium too. And it didn't stop there. And if you remember, this is really important. How easy it is to forget these things and what triggered this. Even in the US, Texas enacted a bill to repatriate $1 billion of its gold from the New York Fed vaults to a newly established state gold bullion depository. Why would you do that? Clearly, the smell of rehypothecation and the risk of your physical was actually even being felt within the US borders. Now, so while Basel III NSFR agreements clearly telegraphed that physical gold would, by its yet to be agreed implementation date, be segregated from leveraged unallocated gold credit transactions, the deleverage process ought to have rolled out in an orderly and seamless fashion. Of course. But this wasn't going to be the case, was it? The slew of central bank requests to repatriate their country's gold stored at the New York Fed followed legitimate rehypothecation concerns when the Fed stalled for time to return this 300 tons of Bundesbank gold. And although along these, if you remember, these rehypothecation questions were really carefully played down by the media. In fact, none of the media carried any of this. I mean, really, what it was a failure to deliver on demand. And really, but it did set off a concatenation of events and a very, very embarrassed Fed. Now, the initial refusal to allow Germany to even inspect their gold really raised questions. And unsurprisingly, of course, they then made a formal demand to repatriate their 300 tons. And they wanted it as quick as possible. But given the Fed was supposedly merely acting as a custodian, a bailee, essentially, this is not their gold. There was no logistical reason why this 300 tons should not have been physically returned within 14 days, which is, 25 tons per insured cargo flight. Could have been done within 2 weeks, not the 7 years they asked. So in a scramble to buy more time to even find this 300 tons. So this is why we're talking a tiny amount of gold from the supposedly thousands of tons sitting there. And then basically this belonged to a sovereign country. The Fed initially, as I say, this 7-year request really did not go down well. And I say, when that triggered a lot of other banks to demand their bullion back, and it triggered questions to audit the Fed. And I think it was those questions about we need to audit this Fed, what is going on, that forced them to really speed up this process. And really somehow it's pretty clear that they'd surreptitiously swapped these positions and they needed time to get this gold back. It was gone. In other words, it was physically there, but the title had been basically traded. So then what happened was, and the reason I go through this is it's important to look back, because this marks the end of the bottom of the entire gold market. So this was the event that triggered it. So essentially they had to go to the market, the Fed had to go to the market to buy this gold back. And having just contained gold, it had just risen over $2,000 in September 2011, and it was undoubtedly being in the process of officially contained, but it was still trading above $1,600. Lord knows where they'd sold or swapped this gold from, but as sure as hell was a hell of a lot less than $1,600. And in fact, it was this counterintuitive containment that had drawn unwanted attention into the reasons why gold was not rising into a period when everyone was saying, look, there's massive, strong physical gold demand. How come the price is not rising? And the Bundesbank repatriation request also coincided with multiple requests from unallocated gold holders in London to take delivery of their gold. And this is all happening at once. Can you imagine the scramble? And to deflect this, there was an attempt to really deflect all of this run on leveraged client metals accounts in London and in Europe. So really what they did was, in fact, this was spurred by, on the 4th of April, it was the 4th of April. I remember clients sent us their letter, we made it public. On the 4th of April 2013, ABN AMRO issued a letter exercising their right to cash settle gold clients. And this exposed another crack in the LBMA unallocated game. So you can imagine this huge concatenation of this massive crack in the whole rehypothecation game was already underway. And one day later, the Fed stepped in, calling an emergency meeting with the President's Working Group. We'll never forget what happened. All the major bullion banks were there. One day later, resulted in a coordinated commencement of a $500 price rigging event. It drove the good price of gold from 1604, I remember it's burned in the brain, 1604 to 1068. I mean, this PSYOPs operation to unwind sufficient swaps continued until the 31st of December 2015 before gold finally bottomed, and bottom it did, but not before China and Russia had broken rank and began to surreptitiously suck up everything on offer. And this competitive physical buying began forcing discipline really on an otherwise synthetic market that has slowly been building ever since. And I think Basel III is the culmination of this price suppression scheme, and it was back almost 10 years ago that these NSFR standards really started this whole repatriation thing. So since then, really global markets have moved to adopt and implement these NSFR standards and are seeking to back their respective currencies with what will ultimately be a significantly higher physically derived gold price. So put another way, it's going to require a hell of a lot more dollars to buy an ounce of physically priced gold.
Wow, so this gold repatriation started over almost 10 years ago, and this is relating to Basel III, of course. But Andrew, the number one question that I'm getting, and that I'm sure that you're getting, and I'm sure that everyone is getting in the gold market is, why are you sure that the LBMA will not succeed in overturning or trying to escape the Basel III gold compliance by the end of this year?
Well, I think the bottom line is, Shane, as far as Basel III relates to gold, paper gold stock is now obviously officially classified as simply risky, and obviously more risky than physical gold stock. So with paper gold no longer counted as an asset equal to physical gold bars or coins, this is ultimately bullish for gold priced in dollars and bearish for unallocated gold. So we know that. And until fully implemented by the end of 2021, I believe it's going to be implemented before that, it currently puts the UK at odds with Europe and the globe. And as far as the UK is concerned, I think this is a point that's not really being covered yet. There are a mixture of issues at play here. And Brexit, the breakup from UK with Europe, is a major. There's a lot of look, the whole independence of London is being fought with the City of London is being fought with Europe on multiple fronts, and we see that everything from in every single area of what's going on between the UK and Europe, which is really a very, very difficult divorce. Now, but as far as gold's concerned, this is actually a fight for the LBMA, and the LBMA is going to have to concede this fight and allow gold to be physically priced. Now, they may win on other areas, trading areas, etc., financial areas, but it's not. Look, if they don't price gold, this is a global fungible asset. If it's not priced correctly, it will be globally arbitraged. It's that simple. So Basel III is a sanctioned global move to revalue gold, and Europe, along with the US, is on board. Everyone's seeking to back their currencies with the respective gold reserves. And as we've discussed I think in our last episode and the one before, what is the bottom line of this? This is ultimately a fight to protect US dollar hegemony. A gold price revaluation has to be implemented. It's simple as that. It cannot be avoided. So very short term, the fight is centered around the unwind of this unallocated over-the-counter contracts. It directly relates to already compliant physically delivered COMEX exchange. And as we've just covered a minute ago, this deleveraging process is an extremely delicate balancing act. It's not a simple process. And in our last episode, we drew attention to some changes in behavior that already became evident after June 28th. And that was gold has been acting as a safe haven alongside the dollar. Remember, this always blew our minds that you could even say in the same breath, gold is a safe haven, as is the dollar. But essentially, from an algo perspective, it has, because gold has actually since then, now, yes, we've seen some pullbacks, but essentially you pull up a dollar chart and you pull up a gold chart both have risen in this month. And so really there is a change in behavior. So really gold, in fact, intraday sometimes rises with the dollar and falls with the dollar. So obviously this has been assisted by real yields, obviously falling to 1 year lows virtually. I mean, but for the sole reason that the COMEX is compliant, though, this automated algo that used to be long dollar, short gold futures, that sell program's been offset by the requirement to manage COMEX gold backwardations from being arbitraged. And that's why I've been concentrating on this, because it's very important to understand that one point. And this will continue while slowly this overhead unallocated supply deleverages. Now, we've evidenced multiple attempts to close gold below 1800, but on each occasion, central banks and sovereign size physical demand forced this backwardation in GC, which would have to be managed by officials and insiders seeking to unwind these rehypothecated unallocated gold positions ahead of December's forced London compliance. So really, we see after Bank of International Settlements expiry on Friday, we see this lid coming off.
Wow. Well, this episode, Andrew, would not be complete without talking about one of my favorite topics. And I know we've got a lot of silver fans out there, but here's what's silver, as everyone can see, is acting very poorly lately in relation to gold. Can you tell us what you're seeing?
Yeah, on the high level and down in the weeds, same thing. Look, these same actors managing unallocated gold unwinds are in the process of unwinding silver overhead supply. And obviously, silver isn't Basel III compliant, but it's joined at the hips. And that's what we've witnessed this, especially into this options-related week this week. And as we outlined last time, silver is joined at the hip to gold, so equally vulnerable to be targeted for delivery. Now, if the exchange physical spreads dip below, and we talked about this last time, below 8 to 12 cents contango between, in other words, the spot price, the futures price should be 8 to 12 cents at least above the spot price. Then what happened this past week? We saw in this smackdown in silver, it dropped down to about 2.6 cents at one point. Now, what that's going to do is result in deliveries. So whereas gold and the dollar are seen as joint safe havens, defeating this usual dollar gold inverse correlated algo, silver futures are still on balance net bearishly beholden to the automated inverse dollar silver or algo selling bots. Now, this culminated this week, and I think it's done. However, the option structure jives with the reports that insiders are one-to-one long against these automated hot money flows. Now, this is a condition insiders must also manage as critically as putting GC gold futures into backwardation. In fact, even more so. And while wholesale 1,000-ounce bars are available, there is fierce competition for these bars anywhere close to the daily spot price. And that was also brought up in the Haraeus letter, where they particularly remark on silver premiums well above spot and how they're rising. So looking at down in the weeds, looking at what happened into silver options expiry yesterday, and we're recording this on Wednesday, the ludicrous options-related action in silver was far too obvious. Someone got a little bit too greedy, targeting some 2,500 puts that we know were layered between 25,750 and 24,500. And it basically, what they do then when somebody, so basically what's happened, these puts would have been sold by specs seeking to gain a little alpha around their positions, thinking that the range is well established, that we were unlikely to get below 26, let alone below 25, but I mean below 26. So they made a lot of bets to say, well, let's gain a little alpha and sell those positions, those options positions. But this is an age-old game. And this is actually part of the evidences in the past that I'm amazed that somebody was so greedy as to do this. But essentially, if you then, as a market maker, you're on the other side of this trade, you target those positions, the guy that sold these and will keep all the premiums if it doesn't go below that price. So basically what's happened is you then push it towards that price, they start to sell futures to hedge their position. And that's exactly what we saw. And you know damn well that the additional short selling and capitulations below the 25 round number provided them extremely large short cover for insiders, which were both ringing the register and one-to-one taking the long side. So look, as far as silver's concerned, it is coiled for an extremely large move. And guess what? There's nobody left to rinse out. There's also no froth in there. Most people are just capitulated or got out. Unless you're a physical stacker. Obviously, you're a winner as a physical stacker because nobody can take this silver away from you. There's just nothing there to rinse. And I see this next move in silver triggered by the same actors exiting these unallocated gold liabilities. And likely we'll see silver in lockstep with the physically driven gold price move into around about 2,500. And I cannot see silver under 50 bucks into the end of the year. And next year, we should evidence double that price, at least, with insiders long and strong.
Wow, buy physical, buy physical. Thank you so much, Andrew Maguire. Another fascinating episode of Live from the Vault. Thank you so much for all that information. I told you it was going to be an awesome show. So with that, help us spread the word here about this channel by liking, sharing, and subscribing. And don't forget, as we mentioned earlier, 9.02 million in yields as of right now. But you can go ahead and log into your free Kinesis.money account, and you can just click on the yields and see these numbers increase. Very, very impressive, historical indeed. Click on the bell if you want to be notified in real time about this. And so with that, we'll see you next time on Live from the Vault. Bye for now.